Hey guys, welcome to today's training where we're going to be going over different ways to be able to help you retire ready. But before we do that, let's go ahead and knock out the disclosure. Feel free to pause the video here and read the disclosure. So some of the topics today, we're going to go over 5 decision-making factors to be able to increase your income by 35% during retirement. We're also going to touch on different types of risks to be aware of that could cost you 30 to 40% of your nest egg. So who's this for? It's for people that want to build, they want to protect and preserve their retirement. It's for people that want to make the absolute best decisions and not run out of money while maintaining their lifestyle. It's for people that are approaching retirement and they don't feel like they're prepared. So who am I? My name is Chris Arnold. I'm the founder and CEO of Redefined Wealth Advisors, and I have over 16 years experience in the financial services industry. I have the experience and the expertise necessary to be able to advise, assist in any type of investment, insurance, and safe money strategy to position you in the best possible position to grow your wealth and create a plan where you'll never outlive your money through the distribution in retirement. I'm an independent fiduciary financial advisor, which means I have access to a multitude of investment options and not just the cookie cutter models, so that we can truly develop a customized financial plan for your best interest with virtually no limitations. I'm born and raised in Texas, and transparency and communication with clients and partners have proven invaluable in making sure that you're fully prepared with a plan for retirement that comes with the peace of mind of never outliving your money. So like Mitch Anthony says, retirement is not about what you're retiring from, but about what you're retiring to. So some of the goals today is really understanding, what does retirement mean to you? You're going to learn about the potential risks that you're facing throughout retirement. You want to understand how long your money will last or needs to last in retirement to be able to maintain your lifestyle and your standard of living. And you also want to learn how to generate retirement income that will last your lifetime. So there's typically 3 financial phases of life. You've got the first phase is the accumulation phase, and that typically falls between the ages of 25 and 55 during the prime earning years. The second phase is preservation, which typically falls between 55 and 65, when preservation of the nest egg becomes much more of the focus. And the last phase is the distribution or the decumulation period, which requires much more complex strategies so that you don't outlive your money. So retirement of the past. Traditional view of retirement: you work at the same company for many years, you retire at the age of 65, you received a pension, Social Security, interest rates are at an all-time high, minimal retirement planning, you purchase insurance from your agent, stocks and mutual funds from your broker, and CDs from your bank. However, retirement now, the landscape's changed dramatically. People are living longer, they're having much more active lifestyles, people are retiring sooner, medical costs are at an all-time high and continue to increase. Pensions are largely a thing of the past, and we've got 10,000 baby boomers turning 65 every single day since 2012 and are going to continue over the next 19 years. Retirement planning today includes things like income planning, which consists of expenses, pensions, Social Security, personal savings, annuities, investments, taxes. You've got healthcare planning, which consists of Medicare and long-term care components. And you've got legacy planning, which is like your estate plans, your wills, trust, your life insurance. But one thing we can all agree on, we're all concerned about the money. How much do I need to retire? How long will my nest egg last me? Will I outlive my money or not? Will I have enough income for my future expenses? And do I want to leave some for the next generation? So understanding potential risks to our retirement. Number 1 is inflation. Inflation hit a 40-year high. So inflation and spending in retirement, things are just going to cost more over time, which is going to erode the value of your savings and reduce the returns. You've got healthcare inflation at 6+%. According to the Senior Citizens League, since 2000, cost of living adjustments have increased 74% for those over the age of 65. If you look at a 3% inflation and what it can do to a $30,000 per year standard of living, in 5 years it's $34,778. In 25 years it's $62,813. So what's my money worth today? If prices were to rise 4% annually, $1 today would be worth 82 cents in 5 years. It would be worth 44 cents in 20 years. What monthly income is required to generate the same purchasing power of $5,000 at a 3% inflation rate in 20 years? It's $9,030. So take Tom and Michelle as an example. They're 55 years old and they plan to retire in 10 years. Their current monthly expenses are $5,000. Estimated monthly expenses in retirement are $4,000. So total estimated monthly expenses in retirement, if it's adjusted for inflation, is $5,376 at the age of 65. So even with a decrease in their monthly spending, they'll actually need more money in retirement due to the inflation. Here's that example continued. $5,376 times 12 is $64,512. In 20 years, they would need $116,508 per year just to maintain that lifestyle. So in total, they would need $3 million during a 30-year retirement, assuming their lifestyle and expenditures remain relatively the same. Risk number 2, sequence of returns. Your number one goal in investing should be to protect investments above all else. It's painful, but it's brief. Here's a snapshot of the S&P 500 since 1928 to 2022. Past bear markets have tended to be shorter than the bull markets, and typically bull markets come back stronger. Since 1957, the average decline took 11 months from top to bottom, and average recovery took 19 months. If you remove the worst 3 bear markets, then the recovery time just took 7 months. So you want to limit large drawdowns. Maximum drawdowns occur infrequently, but they can massively affect your portfolio. And it typically takes years to break even with that pre-crash portfolio value. The graph to the right, a 10% loss would take 11% gain to get back to zero. A 20% loss would need 25% gain to get back to your break-even point, and a 30% loss would need 43% to get back to your break-even point. Years to recover after max drawdown, let's take 25% as an example. If you were averaging 4% annual returns, it would take 7.3 years to recover from the 25% drawdown. If you average 10% returns, it would take 3 years. Average returns don't mean money in your account. It's contrary to what most financial firms say, but let's take $1 million as an example. If you take $1 million and have a 50% loss in 1 year, you now only have $500,000 in your account. In that next year, if you earned 50% return, you don't have $1 million back in your account. You actually only have $750,000. So most financial firms would say a minus 50% return in 1 year and a 50% gain the next year equals 0% average return, where the reality is that it's actually negative 25% in your portfolio. So we never know what the future holds. You've got pandemics, you've got wars, conflicts, geopolitical risk, underfunded pension plans, you've got cybersecurity, data breaches, market volatility. That's why you have to have guaranteed income streams. There's only a few guaranteed income stream options out there, but 4 things that a guaranteed income stream will help with is guaranteeing an income to last your lifetime. You have 0 risk to the market, any market downturns. You've got some of those products providing long-term care benefits. And if we can actually fix your income needs and have that covered, your investment portfolio could assume more risk so that you can grow your portfolio over time. So you've got to have a plan. A 4-step financial plan process. You want to take inventory of your income needs for retirement. You want to clearly identify your retirement and financial goals. You want to create, test, and execute on a plan, and you want to monitor and adjust as necessary. Everyone's situation is different, but there's 4 factors that can be applied to anyone. You've got interest rates. What's the return on your money after inflation? You've got consumption. What do you plan to spend? You've got wealth. How much money or your nest egg have you saved or need to save? And time, the number of years left you have to plan for. Running out of money is a real concern, so you've got to strike a balance between income generation today and the need to grow your assets for the future. So you want to structure a spending policy that reflects a sustainable withdrawal rate. The 4% rule is a rule of thumb that suggests retirees can safely withdraw the amount equal to 4% of their savings during the year they retire and then adjust for inflation each subsequent year for 30 years. However, with increasing inflation, your portfolio is going to need to earn a higher return, or there's a greater chance that your portfolio is going to get depleted. Investment influences to avoid. Multiple factors can influence investment behavior. You've got misinformation online, you've got the media, previous investment experience, influence of family and friends, emotions, both good or bad. And it's time in the market, not timing the market. So you want to stay invested to avoid the risk of missing major opportunities. Here's a trailing 1-year S&P 500 average return. If you miss just 4 of the best days, you reduce the performance by 18.72%. So you want to ride it out. The longer you stay in the market, the greater the potential for positive outcome. A 1-year holding period in the S&P index from years 1927 to 2021 would give a 75% positive outcome. A 10-year holding period would be 97% positive outcome. A 20-year holding period, 100% of the time, is a positive outcome. So the average investor, volatility can drive poor decision making. Here's a 20-year annualized return by asset classes from 2002 to 2021. You can see that the average investor has averaged 3.6%. So like Warren Buffett, we don't have to be smarter than the rest, we just have to be more disciplined than the rest. Discipline equals risk management approach. 4 golden rules to risk managed investing. Rule number 1 is diversify. Since some investments zig when others zag, you want to divide your money across several investment categories, from stocks to bonds to real estate. Also, you want to diversify within categories. Diversification spreads the risk and guards against a large market decline in any one investment. Rule number 2, you want to rebalance. Have a financial advisor review your portfolio at least once per year to make sure your mix of investments hasn't strayed from your original goals or risk tolerance. If it has, exchange some of the investments that have performed well with other underperformers to regain the balance. Rule number 3, dollar cost averaging. Fear can cause investors to miss buying opportunities when prices are low. Euphoria can cause them to buy high. By investing the same amount in the same investments on a regular basis, dollar cost averaging takes emotion out of the equation. Rule number 4, you have to have a strategy. Work with a professional to determine what the best strategy, whether that be growth, defensive, fixed income, or other options that are available to you. Every investor is unique, so avoid the one-size-fits-all investments. Here's a 3-step approach to diversification. Create a tailored investment plan. You want to invest at an appropriate level of risk, and you want to manage your plan. So you want to evaluate your investments periodically for changes in strategy, relative performance, and risk. Building a diversified portfolio. What's your risk profile? Are you conservative? Are you moderate? Are you aggressive? Conservative would be the primary goal is to generate income with minor equity holdings for diversification. Moderate would be primary goal of balance and capital appreciation potential and income production. And aggressive, the primary goal is growth and is willing to accept a wide market volatility. A simple way of determining your risk tolerance is the rule of 100. So your age multiplied equals the percentage of the fixed income or those safer investments. A better way to determine the risk tolerance is leveraging risk tolerance software. So you want to create a personalized risk score from a series of questions and mathematical assessments to pinpoint exactly how much risk an investor wants. Manage risk, don't avoid it. Risk management strategies, dollar cost averaging, asset allocation, professional management. And there's 3 common sources of income in retirement. You've got pensions and retirement plans, with typically money from your employer. You've got Social Security, money from the government. And you have personal savings, which is money that you've saved or invested. Retirement income planning and investing is only one piece of the puzzle. You've got pensions and annuities. Do you take the lump sum or not? You've got Social Security. What's the best age to take Social Security? You've got taxes and retirement, life insurance, long-term care, and Medicare. And here are 5 decisions that can provide 35% more income during retirement. Number 1 is Social Security claiming age. Many people claim Social Security at 62, and it's oftentimes because they don't have other available sources of income during retirement. Deferring claiming can greatly increase the amount of income received from Social Security. Number 2 is the dynamic withdrawal strategy. A common withdrawal strategy is the 4% rule, which takes 4% of your initial account balance and adjusts it annually for inflation. A dynamic withdrawal strategy should be more unique to every individual's needs based on years remaining and return expectations. Number 3, tax efficiency. Oftentimes, the tax alpha is overlooked when constructing portfolios. Tax efficiency can be greatly improved just by allocating your bond assets to tax-free accounts like a Roth IRA or a Roth 401k, then taking the stock assets and directing them into taxable accounts. Oftentimes, naive investors proportionally allocate all of the assets equally across the board without specifying which assets go into which account for tax efficiency purposes. Number 4, total wealth asset allocation. Your portfolio design should take more of a holistic approach. An example, if a retiree receives 80% of their income from Social Security or other guaranteed income sources, they could have a more aggressive portfolio design than some retiree that only receives 20% of their income from Social Security. And number 5 is annuity allocation. Oftentimes, naive investors opt out of creating additional guaranteed income from annuities, which could greatly improve their situation. Because as of today, there's only 3 ways to get guaranteed income for life, and that's Social Security, a company pension, and buying an annuity. So financial advisors can help you mitigate the risk. Working with the financial advisor, the right fiduciary financial advisor, can help act as your fiscal coach to create a comprehensive long-term personalized plan for you. They can rebalance your portfolio and investment accounts along the way to help mitigate risk and limit large losses. They can help you determine what your best tax advantage strategy is in retirement. They can help you avoid paying too much in commissions with stockbrokers. They can offer you insights and education to avoid following the press to help take emotions out of investing. They can educate you on other financial products and strategies you might not be aware of to be able to get you a better return of your money. And they might offer other common retirement questions and advice, including Social Security, estate planning, tax planning, including charitable giving strategies. Now, you've learned a good amount of information today, and you have two options. You can try it on your own, you can study the tax laws, you can sift thousands of stocks, bonds, mutual funds, ETFs, insurance products, and you can try to construct a decent portfolio. You can hope and pray it works out. Or you could book a call with my team and learn how we've successfully been able to piece the puzzles together over the last 16 years for hundreds of others before you. So who's this for? It's for people that want to build, they want to protect, and they want to preserve their retirement. It's for people that want to make the absolute best decisions and not run out of money while maintaining the lifestyle. And it's for people that want to protect their nest egg from any market volatility. So I want to thank you guys for joining me today, and I hope you got value from it, but we're not done yet. You still have to take some action. So click the link below and fill out the questions and book your consultation with us. We're ready to put you on the right path to a successful retirement plan. Again, just click the link below to book your spots, and spaces are limited, and we look forward to seeing you soon.